Hey everyone, and welcome to today's Explainer. Now, for all of you political science students tuning in, we're going to take a really deep dive today into the actual architecture of modern state power. But here's the catch. We aren't going to be looking at legislatures or courts or militaries. We are looking at banks. The core premise of our lecture today, drawn straight from our source text, is essentially deconstructing this massive, pervasive myth that banks are just neutral intermediaries. Instead, we're exploring a totally fascinating and honestly kind of unsettling argument, the idea that banks actually function as modern sovereigns.
Right off the bat, the text drops this incredibly striking, provocative quote. The crown was never lost, it was loaned. The author is arguing that the immense, absolute power that monarchs used to hold didn't just evaporate when we shifted to democratic republics. No, that sovereignty simply migrated. It packed up and moved away from thrones and royal decrees and relocated directly into financial ledgers. So let's unpack exactly how our source material maps out this monumental shift in power.
All right, let's jump right into the syllabus for today. The text covers 6 key areas of institutional power. First, the myth of neutral banks. Second, the historical jump from coinage to credit. Third, the central banking empire. Fourth, state-backed sovereign banks. Fifth, governance through debt. And lastly, the digital future of money.
Okay, Section 1, the myth of neutral banks. We're looking at the tension here between banks acting merely as intermediaries versus acting as actual creators.
So, you know how we're usually taught that banks are basically just financial plumbing, right? They take in deposits from savers and then pass those exact same funds out to borrowers. Well, the text claims this is a foundational illusion. The source draws a really hard line between state-issued currency and credit. Credit, as it's defined here, is a promise or an IOU that actually mints new claims on future labor. Basically, the author says that when banks extend loans, they aren't just shifting existing money around. With a few simple keystrokes, they are literally conjuring brand new money into existence.
And this conjuring? It has a massive real-world impact. Just contrast the traditional textbook view, where markets are these perfectly neutral spaces driven by organic supply and demand, with the reality this text proposes. The argument is that markets are actually heavily engineered terrains, driven entirely by commercial lenders. The constant expansions and contractions of bank balance sheets are what truly drive the booms, the busts, and the massive asset bubbles we see. The author posits that this state-sanctioned credit creation literally shapes our economic destiny.
Moving right along to Section 2, from coinage to credit. Here we'll look at the historical delegation of monetary power.
So, how exactly did kings lose this ultimate power? Historically, stamping your face onto a physical coin was the absolute mark of sovereignty. Controlling money creation was the most jealously guarded power a monarch had. But as states needed to finance larger and larger wars, they started delegating this power out. Look at this progression. Back in 1609, the Bank of Amsterdam gets chartered. Then, by 1694, the Bank of England is created. And this is a massive turning point. The source points out that early public banks, like the Bank of England, were granted monopoly privileges specifically in exchange for financing state debt. It was this literal fusion of state power and private profit. And this model spread, eventually culminating here in the US with the creation of the Federal Reserve in 1913.
Which brings us to an absolutely crucial concept from the reading. Sovereignty became fractionated. Monetary sovereignty didn't just vanish when the monarchs lost their absolute grip. The text argues it was quietly distributed. The state kept the symbolic, outward power of declaring what legal tender is, but the actual functional power of creating the money supply, that was handed over to an economy governed by private bank balance sheets. For us studying state power, this totally reframes where we should actually be looking to understand who governs us.
And that leads us directly into Section 3, the central banking empire, or what the text cleverly calls the technocratic sovereign.
Okay, so to stabilize the absolute chaos of the private credit we just talked about, the Federal Reserve was built, and it was endowed with staggering powers. I mean, it controls interest rates, it regulates market liquidity, it dictates the cost of borrowing for everyone, and it executes sweeping emergency bailouts. But here's the crucial takeaway the text really hammers home. This institution is entirely insulated from direct democratic oversight. The author argues that this setup creates an unaccountable, technocratic empire that makes decisions profoundly affecting wealth distribution and employment, often prioritizing pure financial stability way above everyday social well-being.
And there is literally no better example of this than the year 2008. The text points to the 2008 financial crisis, and, again, to 2020 actually, as prime examples of central banks wielding sovereign emergency authority. During these crises, the Fed didn't just tweak a few policies. They stepped in and bought trillions of dollars in distressed assets to rescue key financial institutions. Trillions. The author frames this as the central bank acting as the ultimate guarantor of capitalism itself, using powers that far surpass normal democratic governance to basically adjudicate who survives and who faces ruin.
Now, let's shift to Section 4, State-Backed Sovereign Banks. The text views everyday commercial banks as what it calls vassal lords, endowed with extraordinary powers.
So how exactly do standard commercial banks get this kind of royal power? Let's walk through the architecture the source lays out. Step 1. The state officially guarantees their deposits through mechanisms like the FDIC. Step 2. Banks get to access emergency, sovereign liquidity through the Federal Reserve's discount window. That is a privilege basically no regular company ever gets. Step 3. They grow so massively interconnected that they become officially too big to fail. The text argues this exact structure transforms banks into quasi-sovereigns. Why? Because the general public is unwittingly forced to co-sign on their private risk-taking.
Let's look at this comparison for a second. Traditionally, a state exerts its rule through things like taxation, standing armies, and the rule of law, right? But today, the source claims banks rule through credit allocation, discount windows, and sheer indispensability. Their power doesn't come from an electoral mandate. It comes from the systemic threat that we simply cannot afford to let them collapse. They literally govern through liquidity, which the text provocatively argues has become a deeper law than the legal system itself.
All right, on to Section 5, Governance through Debt. This looks at credit as a form of delegated societal judgment.
So the text argues that credit allocation creates this really strict moral hierarchy of belonging, a kind of moral architecture of capitalism. Think about it culturally. The creditor is almost always framed as virtuous, disciplined, the rational actor, while the debtor? They're framed as reckless, irresponsible, and morally suspect. But the author makes a really sharp critique here. They argue that creditors actually manufacture the conditions of scarcity by shaping wages, housing markets, and capital flows, and then they place the stigma of moral failure squarely onto the debtor, who is just forced to borrow to survive.
And we see this play out throughout history. The text brings receipts, citing very specific instruments of debt governance. We see it clearly in the historical Homeowners Loan Corporation redlining maps, which literally codified racial exclusion by denying mortgages to black neighborhoods. We see it in predatory payday and subprime loans that specifically target the vulnerable. Meanwhile, big hedge funds get preferential liquidity. And today it's algorithms sorting human risk. The text presents these not as weird market glitches, but as credit acting as an intentional weapon of political subordination.
To really wrap up this section, the text makes this bold, sweeping claim. Sovereignty has migrated from legislatures to ledgers. It is debt. It's your car payments, student loans, mortgage rates, even municipal bonds for your local city fire station. That is what dictates social mobility, dictates where you can live, and governs the public far more immediately than our elected officials do.
Which leads us to our final section, the digital future. We are looking at the transition from coin to paper and now directly to code.
The source outlines how this rapid transition to programmable digital money, things like central bank digital currencies or CBDCs, and platform capital carries extraordinary risks. Think about it. Programmable money could literally be geo-fenced, so you can only spend it in certain areas, or it could be set to expire if you don't spend it fast enough. Monetary policy could become micro-targeted at individuals. Surveillance becomes baked right into the medium of exchange itself. And AI-driven credit scoring could automate and severely deepen financial exclusion. The text warns us that this shift from paper to code threatens to obscure monetary rule behind complex algorithms, which further erodes any remaining democratic accountability we might have left.
And I want to leave you all with this highly provocative question straight from the conclusion of our text. For us political science students studying the realities of state power, this right here is the frontier. Who will control the digital infrastructure through which all of our economic life flows? Will money remain a public instrument, however flawed it might be? Or is it destined to become completely privatized, algorithmic governance? Think about how the crown was loaned out in the first place and ask yourself, who holds the ledger next?